Welcome to this webinar or discussion about financial operational planning and performance management processes and solutions in complex manufacturers. And this is really more of an assessment of the current state and potential options. And this um, session is being done by the Profitability Analytics Center of Excellence. And the panelists are myself, Dean Sorensen, and Richard Herron. And we're members of the Profitability Analytics Center of Excellence. And one of the things that we're doing is kind of looking at financial and operational planning and performance management processes more holistically. Um, so Richard, I know has been in the sales and operations planning, integrated business planning space for many years. And Richard, I know perhaps you can just kind of give a quick thought about uh, some of the things that you are that interest you about this subject, and I'll do likewise.
Oh, sure, sure. Thanks. Good to talk to you again, Dean. Um, my name's Richard Herron. I have been involved in advanced sales and operations planning, integrated business planning now for well on 30 years with big companies. I've been in where I've worked directly for the companies and in a consulting roles with a lot of companies, in a lot of industries too. I tell you what. 30 years in the business, and it's to say it hasn't been a struggle would be a blatant lie. Uh, what excites me now is that we're on the edge of some really interesting technology, some really interesting breakthroughs that I think are really going to enable a lot of these goals that we've had for IBP that most of us who've been trying to implement it have been struggling to achieve. So I think we've got a good, I think now's the time that there's about to be big, big changes, big growth opportunities in this field.
Yeah. Yeah, I would agree. So again, this is Dean, and I've been in this integrated space, planning space for a number of years, but really focused in the last 20 years or so on integrated planning and performance management. And you can see that I worked with many manufacturers before, but one thing that I think is unique about me is that I have kind of deep financial and supply chain planning experience, so I'm probably about as deep in finance as I am in operations, despite the fact that my background is in public accounting many years ago. So one of the things I think that I find, and wanted to try and have one picture that kind of summarized this, is that if you look at the current state of financial and operational planning, what I see is a whole bunch of things kind of falling between the cracks. So, these financial and operational planning solutions tend to be more on the siloed stage. So, and that's what, this slide template, if you will, is depicting that finance and operations really are operating kind of independently. And Richard, are you finding similar sorts of things?
Yeah. Every application, right? It's everybody throws out the word a consensus or an integrated planning tool, but every implementation previously I've been on, it's really been a mismatch of different, I'll put in a demand tool for the commercial group, separate of a tool for the supply planners, typically an ERP system. A financial system will be typically different. I've got a mix of different applications I'm trying to cobble together. Um, what that has always done is that's kind of pushed away from integration, right? If the holy grail to me in planning is I have a demand manager, a supply manager, and a financial manager looking over each other's shoulder at the same screen, trying to make decisions and seeing the impact of all those decisions instantaneously. Well, the tools have kind of prevented me from doing that because now I got a demand manager working in a forecasting tool, most of the time an Excel spreadsheet in the front end. They pass that over the supply chain. Supply chain does their magic in the ERP system. The demand managers never never talk. I mean, until months later, they don't come back and talk demand plans, right? And then after we get a balance in an ERP system, we push that over to a financial system where financial analysts will summarize everything, and then once that's all summarized, they'll try and make, well, here are some gaps. Well, how are we going to close these gaps? And at the top end, they'll close the gaps at the macro level, but those macro level changes never get down to something operational because these are all different disconnected systems and steps within the planning process. Does that make sense to you,
Yeah.
Dean?
Yeah, and I find similar things, and I think that the reason I put up this graphic is that, one of the things I find is that especially when talking to kind of people who've been through the whole thing, they've done FP&A, they've done IBP, they've done business intelligence, you name it, they've done it. And the challenge that they still have is all the things that you just said, a lot of those problems still exist. So, and the thing is that the bigger you get, the more likely it is that you're going to
Yeah.
have these problems. So it's really a complexity thing. So, it's difficult to define when companies hit complexity, but I typically find that between a half a billion and a billion that you really start hitting real complexity issues. So, so not only are you not meeting your objectives, one of the things that these tools are not and processes are not doing is that they're not optimizing profitability and value. When what's more, the solutions are not terribly cost effective because they're awfully manually intensive. And one of the things is that, the way that we're kind of looking at maturity. So if you see this kind of maturity model here. And I think a lot of kind of technology analysts will use something like that to describe, how good a planning model is or a solution is, that they're really not as mature as people think. And um, I think that there really is no one way of looking at maturity. So this was initially my attempt to try to define where we are from both a planning and performance management perspective, and that, the fully integrated solutions, I think there's a big gap between where we're at now and what fully integrated is. So from a supply chain planning perspective, you're now having people look at this term or this approach called outside in integrated business planning. And from a financial perspective, um, you have people looking at integrated reporting, ESG, integrated thinking, or other terms. So we're looking at integration really from a very fragmented perspective. And in so doing, one of the things I don't think that we're doing is that we're not really enabling any of these sorts of transformation. I think that when we get into it, you'll see that, most transformation efforts are really failing because of this capability gap. And that one of the things that what we want to try to describe is that, you know, both process and technology innovations are driving much greater value than legacy solutions. And it'll take you less time to get there with lower costs for both the process and the technology, and that the numbers get pretty big pretty fast. So it's not that integrated business planning doesn't exist, but I think, when you look at how people describe integrated business planning, I think in a lot of ways they're often being, I guess, what I would call it, like or maybe not exaggerating, but I think they're being a little overly optimistic as to what integrated planning really does. Would you find that, Richard?
Yeah, yeah. Especially the more complex the business get, right? I mean, the difference between S&OP and IBP for us, a very simple value chain. Say I've got two or three plants within one region. I've got one typical customer base. IBP is not that difficult to do, right? But it's when I start growing. So, okay, well, now I've got not only multiple plants, I've got multiple regions. I've got to make decisions on, do I produce this in South America? Do I produce this in Asia Pacific? Right? When I've got different business units competing for the same resources coming off these plants, it gets a lot more complicated. And okay, now I've got to start um, consolidating across business units. I got to start making decisions against uh, markets based on which ones could be more valuable, things like that, right? It gets a lot more difficult as we go up. This is why in my past global companies, you know, we probably on a monthly basis would do what we would call sales and operations planning, but we wouldn't get to the what we considered IBP until quarterly based because we just didn't have the time and we didn't have the tools to support doing it monthly.
Right.
But that's all
So
changing now. Okay.
yeah, so we'll get into that when we get into the, especially when we get into the process. But one of the things what we want to do now is just go over the agenda for today. So let's walk through what we're going to be covering. So here's kind of one of the main things that we want to get across. So when we talk about fully integrated, I think there's some disconnects in terms of what I think fully integrated is and what others are describing it as, and which is why I think there's some critical flaws in kind of the legacy planning and process, performance management processes and solutions. And as a result of that, one of the things I want to highlight is I think that the way that technology analysts and, experts are viewing kind of like mature processes, I think is really I think it's really very siloed and outdated and in many cases materially misleading, which is one of the reasons why, this profitability analytics group exists to kind of expose some of these things. So once we get through describing what we think fully integrated is and what the flaws are, one of the things also want to talk about is that the fact that these flaws are not new. They've been known for many years. So what we'll do is talk about why that is and how it impacts finance from a profitability management perspective and operations from a commercial perspective. Then I'm going to get specific into planning models and have, Richard and I will talk about this a little bit because I think that um, when you think about planning models, there's this perception that, in a lot of cases that these different tools do some pretty um, uh, support some pretty sophisticated planning models and systems, which in fact I don't necessarily think is the case always. So we'll define what that is. And then the next thing we'll talk about are more from a financial perspective, and I'm going to use a specific case study to describe this. But the reality is that in a lot of cases, traditional or legacy FP&A processes and solutions are actually eroding value, undermining strategy, as well as finance, all forms of transformation, especially finance. And a big part of that has to do with kind of like rolling forecasts, budgeting, that kind of thing. But one of the things that we'll talk about in section 5 is what a mature rolling forecast does and how it integrates with sales and operations planning, integrated planning, and its impact on kind of the budgeting process. Then we'll come back to what I talked about before. We'll leverage all these things that we've talked about and describe why we have these perspectives about maturity models. We'll provide some perspective about some related issues that relate to integrated planning, like outside in IBP, ESG, integrated reporting and thinking. Then we'll summarize at the end and talk about how you can best leverage these insights to maximize the value, time to value, and really kind of avoid the missteps that, many people have experienced so far. And then at the end, we'll kind of summarize what we think the value opportunities are by taking a more holistic approach. Okay, so let's describe what we mean by fully integrated, and we'll talk about some of the flaws that we've seen. So there's kind of four things I'm going to talk about in this section, and I wanted to be able to, you know, digest it down to like the minimal few, and these are kind of the some of the things that both Richard and I have talked about. So the first thing that we're going to talk about this idea of having an executable plan. And the idea of an executable plan means the ability to simultaneously translate demand into financial and operational plans. And a big part of this is be able to quantify how demand affects both direct resources and indirect resources, and where the problems start. And the thing that we're gonna follow through this entire video is that where the problems start is that these indirect resources. Because of both the financial and operational planning solutions, the models calculating these things are either overly simplistic or just wrong. And the implication is that you're actually not able to calculate all these things. And what really should be happening is that not only should you be able to calculate all these things concurrently, you should be able to do that in a day. So from the time that you calculate, finalize what your demand plan, to the time that you actually calculate what your plan is going to be and derive what it's going to be, and have people agree with it in the different functions, you should be able to do that in less than a day. And I know, Richard, that's been a point of contention for you, right?
Yeah, yeah, it is so many times I get into an executive S&OP meeting and we'll present the plans to the C level. And you'll get the CEO of the company to look and go, well, wait a minute, that demand plan you're showing me is 4 weeks old or whatever. It's an old demand. We've made decisions in the last 3 weeks. We've done things, taken a lot of actions to either increase revenue, to try and grab more market share. And the CFO, the supply officer will jump in there and go, well, wait a minute, that supply plan you're showing me, we built based on that demand plan. If you're telling me that demand plan's wrong, well, my supply plan is wrong. Um, and then, it comes up to the CFO who's, well, okay, well, I just dollarized a demand and a supply plan that you guys built, and it's old already. What decisions are we making? We can't make them on this old data, right? Typically it takes you the 4 weeks of the process because it's sequential. It's a sequential
Right.
process, a handoff, right?
Exactly.
Um, yeah, you get to a point where people don't trust the numbers, and you go, well, now we're focused on short term. Go, well, I
Yeah.
can't trust in these plans, right?
So one of the things that should be coming out, as just to make sure we understand, is an operational plan that's fully reconciled to a projected set of financials, which reconcile to like a detailed direct cash flow and working capital forecast, a forecast of product, customer, and segment profitability based on, I'll call it activity-based costing, but just something that's accurate. You should be able to figure out how many people do I need and which functions and one that we'll get into a little bit later, it should forecast what your business process costs are and the productivity. It should be telling you what your manufacturing variances are relative to, especially your budget, like where you off, what are your volume and mix variances, and should also be telling you where your customer segment profitability variances are. So it's a pretty complete list, and one of the things we'll talk about is how you actually deliver something like that. And one of the things as well is that if you don't have something like that, then whatever you're using for scenario planning probably isn't going to be terribly helpful. And that's actually one of the things when you look at, the solutions out there today and the processes that scenario planning, like if you listen to what people are talking about with scenario planning, you'd swear they solve world hunger, and that's just not the reality is not even really close to being the truth, especially when it comes to things like in today's world, like tariffs, or when you think about COVID, like people when these events happened, like especially COVID, people were really looking for things that could actually help them look at like how do I respond to this more holistically, and the reality that this just doesn't exist. and especially when you get into big companies. And that, especially from a finance perspective, if you had this sort of thing, like one of the things that your monthly rolling forecast and IBP should be less than 2.5 weeks, and your annual budgeting process ought to be less than a month. You shouldn't be doing any of these things. Like if you were fully integrated, you wouldn't be doing any manual reconciliation. You wouldn't have any separate financial and operational processes. There wouldn't be any separate financial or operational models. Just a lot of things end up really going away. And the reality of this, especially when you look inside of a lot of big manufacturers, I mean, we have a burgeoning supply chain finance function that's actually doing all this stuff manually. And one of the things that also, as I mentioned before, ought to go away are kind of the detailed variance analyses, as well as one of the things that should go away is the need for special cost reduction studies, because what should be happening is that if you are fully integrated, your cost structures should kind of self-adjust to changing market conditions. And like if you're a smaller company, you don't have big overhead cost structures, you might argue that IBP is already doing this, and in a lot of cases it is. But when you get into big companies, kind of like what we said beyond the $500 million mark, and up, this just isn't happening. I mean, this is, when people talk about integrated business planning, they're not reaching this kind of maturity. So this is sort of the vision that we're going to be talking about in terms of, what we think fully integrated is and how organizations um, can look at it things differently. So just to summarize, these are kind of like the four things that we talked about, and we'll get into that in a little bit more detail. Okay, so let's talk about profitability and commercial management. And so again, one of the things we're going to talk about are known capability gaps that really haven't been addressed by legacy solutions. So the first thing is that just going back to the slide that we started off with is that you know the, these legacy solutions really aren't helping companies optimize profitability in complex companies. And much of this comes down to decision making. Um, so for like especially with kind of like operational solutions like supply chain planning solutions, they're doing like a really good job. Like if you're trying to figure out what the optimal response to kind of changing demand patterns and how do I maximize revenue and minimize production costs in the short term, they're doing a wonderful job at that. No problem there. It's when you start getting into these longer term decisions. So while, we're able to make the right short term decisions, not so much on the long term decisions. And really where this becomes problematic is in the complex companies when you look at their cost structure. So as you become more complex, these overhead costs represent a significantly greater portion of your cost structure and become far more relevant to your decision making. And I need to go back to, like, I've done lots and lots of cost management work, cost reduction work, or cost engineering work, whatever you want to call it. But one of the things that has been proven by it's got to be hundreds of thousands, if not millions, of activity-based costing projects, is that both, and you get into complex companies, they're using kind of overly simplistic costing and planning models, and the reality is that become materially inaccurate. So from a costing perspective, you're either under or over costing, but more from an operational perspective, you're under resourcing or over resourcing. So that's really what's happening. And again, this is not a new thing. And if you look at the output of activity-based costing projects, the net result is a big part of your product and customer portfolio are unprofitable. And again, this slide here shows what's called like a humpback whale curve that, a small portion of your products and customers are profitable, the other ones are not. And this curve is so prevalent, and it's so common. They call it a humpback whale curve. So it's again, it's nothing new. And one of the things is that um, what you're finding from activity-based costing is really the outcome or the consequence of making wrong decisions. And this is one thing a couple of years ago in Gartner's CFO conference. One of the things that this was sort of the focal point of their entire conference was that companies weren't able to make cross-functional trade-off decisions. And especially as it relates to new products, customers, and suppliers. So, I mean, the problem being like companies can't quantify how, decisions relating to these things impact free cash flow as well as all aspects of performance. And what happens is that you end up with what's called complexity costs. And, you can see some estimates of what complexity costs, but ultimately they're the cumulative cost of wrong decisions expressed in terms of free cash flow. So when you do activity-based costing work, it's not unusual to find value opportunities approaching what we're showing here as a cost of complexity, sometimes lower, sometimes even much higher. And one of the reasons why companies end up having these costs of complexity is that companies can't sustain cost reduction. So, there's six research studies here, basically all saying the same thing. So actually, five of them ended up saying that 90% failed to sustain cost reductions for more than 3 years. And this is pretty common, and companies are still having problems with this. So what you end up with is that in a lot of companies, as you make a cost reduction and start operating, the costs creep back in. So it's not unusual to find like what I call an opportunity to reduce costs of somewhere between 3 to 5% of year, 3 to 5% of sales. So between $1 billion and $10 billion, the range is going to be somewhere between 10 to $500 million of cost reduction opportunities. You can see that, it gets greater as the complexity increases. And from an IBP perspective, what it's showing here is that, you might be realizing a lot of value from your IBP and S&OP, but you're realizing less as you get more complex. You're realizing less and less of what you should be realizing, so you're not realizing any of the strategic value. So when you're a small company, you're probably getting the most out of IBP because, complex overhead costs may not represent a significant portion of your decision criteria, but when you get into bigger ones, that's just not the case. So what's end up happening as you start looking at the extremes here, towards the left, in smaller companies, overhead costs are manageable, and you get into bigger ones, they're just, they get to the point where unmanageable. So you're pouring all these resources, especially manual resources, trying to manage the business and make these decisions, and you're just not able to do so. So you're just not able to make the decisions that you need. So, you reach a point where manual workarounds just don't work anymore. So you're really having these problems. And especially when, as I mentioned before, so this is what a lot of supply chain finance functions spend the time doing is trying to, avoid these wrong decisions and make the right ones. And they kind of like the classic case relates to new products. So in a lot of cases, companies may design products to meet specific uh, target cost needs for a customer. So in a more traditional and focused world, what you may be focusing on, minimizing direct costs. So that means I'm going to source specific materials to meet those direct cost targets. But the problem is you're not looking at the big picture. So it may be that, you're introducing so much complexity into the organization when all is said and done, by introducing this complexity, you're actually decreasing cash flow. So if you actually had a model that could tell you, does my cash go up or down because of introducing this new product, you'd be making a totally different decision. And that's one of the biggest problems that companies have, is that they don't have that. And to me, that's what a really good integrated planning system ought to do, is tell you how does this decision impact direct cash flow. And for those of you that have heard of the term, economic value or managing for value, this is exactly the point that they were making is that we're using these kind of disconnected points decision solutions and processes to make these decisions. And you can extend that same issue to suppliers. So by the time that you make these decisions, you're also introducing complexity into your supplier base, and you may be picking the wrong supplier. And likewise with customers. So you may be making decisions about pricing based on the expected costs and cost to serve with specific customers, but you end up finding that the customers are far more complicated to serve. So you really need to be able to be more explicit in terms of how you think about these decisions. So when you talk about making decisions, you need to be able to have the right amount of or the right information to drive it. And one of the implications that's not always considered, that one of the things that often typically comes out of activity-based costing is that not only your product and customer is your product and customer profitability wrong, but so too is your segment profitability. And that becomes especially problematic because a lot of companies are still managing segments based on gross profits, not on net profits. So you think maybe you're managing at maybe 60% of your cost base as opposed to 80% of your cost base. So, and it's not just managing profits, but it's the ability to manage financial and operational outcomes. So, minimizing costs while maximizing customer experiences. And when you think about this, the reality is that legacy solutions have never addressed this. You know, uh, especially, supply chain planning solutions have not addressed it, nor have FP&A solutions. So this whole idea of, understanding cost structures has never been fixed. So what you end up with is, in a lot of cases, you get uh, companies or software companies or solution providers providing companies with solutions that are based on a number of really invalid assumptions, especially in the case of FP&A solutions, where, if you're using kind of averages to make decisions, I mean, ultimately, you're relying on, say, activity-based costing to detect them. Basically, one of the things that these software companies are assuming is that fixing decisions after the fact with activity-based costing is going to result in the same values, avoiding them in the first place. And I think, Richard, you've probably run across this with supply chain planning solutions who are using these exact same overhead rates or wrong costing
Yep.
models that I just talked to you about.
Yeah, yeah, it's tell you, a good example I've dealt with. If we've got multiple plants, I've got one plant where the conversion costs are deemed to be a little too high. Well, the first thing we do then, okay, well, let's put more volume into the plant where the conversion costs are too high to get overall conversion costs down, right? Because my direct cost isn't going to change by moving it from plant, but a big part of conversion cost are these overhead costs. Well, I'll move volume from other plants to load one plant. I'll make that plant look better on a direct cost. But then every other product that's still being made at all these other plants, well, their conversion costs go up because,
Yeah.
yeah,
Yeah, and
it's the same. Go ahead.
yeah, well, I was just going to build on it because this is one of the biggest problems with when you look at kind of traditional supply chain planning and S&OP solutions that, while they may work well for kind of a standalone plant that doesn't have a big overhead cost structure, the reality is that the bigger you get, the more likely it is these tools are giving you
Yep.
precisely the wrong answer because their models are just, you can call them incomplete, but I just call them they're just wrong.
Yeah.
There's, right?
Yeah, we'll make a decision in an executive S&OP that we think is going to give us a certain financial impact. We'll come back a couple of months later and go, well, we didn't get that financial impact. Why not? Well, our financial model wasn't integrated with our operational model at anything more than a direct cost level, right?
Yeah, exactly. So,
Yeah.
I mean, one of the big things that ought to go away when you're fully integrated you should never have performance surprises. And I tell you, like I say, a lot of these tools that talk about being fully integrated are not even remotely close to offering that kind of insight. So anyway, so that's one of the main things to think about in terms of, from this section, the major takeaways is that a lot of these tools are incomplete and they're missing a big part of your cost structure.
Another good example on the commercial side of this is if I offer the same service across the board for a specific product, I haven't segmented the customers. Well, I may be offering that product and that service at different prices for the different markets, but on the supply side or on the support side, well, it's the same cost for me. I haven't differentiated the cost, so I'm actually losing margin by offering the same, by not segmenting, as you were saying, to along the commercial
Right,
areas.
right. And again, it comes down to if you understood your cash flow, you probably wouldn't have this
Yep,
problem in the first place.
yep.
Okay, so let's get into planning models. Now, here's the kind of the key insight here. Again, this is kind of picking up to what we just talked about in the last section. So we're going to dive into this in a little bit more detail. So again, the main point here is like when you get bigger, we could give a lot of reasons why you get, information that's not right, but we'll just say the reality is that the models are just they're wrong. So we're just going to talk about, well, why is that? So one thing I wanted to point out here is that because I've kind of had experience with kind of both financial and operational models, when you look out there, one of the things that you often hear, especially within financial planning analysis and then extended planning analysis, like how mature and how great these models are. Well, as somebody who's actually used kind of the more like prescriptive analytics and supply chain models, the reality is that the models in these FP&A tools are not even remotely close to being as sophisticated as the supply chain planning solutions. So the thing I have here, like here's kind of a Ferrari, a brand new Ferrari compared to a 64 Volkswagen. Just not so good. So, and from a direct cost perspective, so while some of the financial planning solutions, they may be able to use some of the outputs of like you know, bill of material or routing or something like that. They're not even remotely close to being able to do anything that kind of a good supply chain planning solution doing. So I want to make that point first that, when you're looking for really good financial planning, if you look at a lot of the financial planning vendors, they're probably, the vast majority of them are really just not well suited for complex manufacturing, and I'm getting into details as to why that is. So here's kind of like my hundred foot view of why this is like financial planning. Oh, one thing about these tools that you tend to end up using a lot of averages and very simple equations as opposed to what I call fully integrated solutions that can deal with a whole bunch of operational reality. And that's really kind of the difference between the two in terms of their ability to really kind of fully integrated ones are more mature supply chain ones, if you will, are able to quantify resource consumption. And in operational tools, or supply chain planning tools that really aren't as sophisticated, they're making these kind of like overarching assumptions that, don't recognize these sorts of operational realities. So you get this is what the kind of like these overhead resources and cost structures. So they're not all that accurate either. And this goes back to this trade-off thing that we talked about in the last section. Now, I wanted to make a point here. I used to work for a company called Genova. It was a prescriptive analytics software company. Now, it's a defunct company, so I'm not promoting anything. But one of the reasons, I have a little bit to offer here in terms of what constitutes a really good planning tool or a planning system is that we save companies some huge amounts of money. And one of the things that it did in saving this money is that it utilized some very sophisticated planning models. And the thing about it, they're embedded planning models that not only did supply chain planning, but did planning outside the supply chain as well. And um, one of the things when we get to a little later, it incorporated things outside, kind of like manufacturing, and I'm going to give you a warehouse example, but you could extend it back into kind of like non-traditional types of things like back office type things. But one of the reasons why the solutions really doesn't exist anymore is that it took a lot of time and effort to manage and maintain the models and as well as to try and integrate it with existing processes. And that's one of the things that's kind of different about the today's technologies. But I just want to focus on what the models do because I think it's really important for both supply chain and financial people to really understand that what constitutes a really sophisticated model is different than what you might think it is. And one of the things that these models do is one of the things I talked about in the last section on activity-based costing is it allows you to simulate, a business horizontally across legal entities. And one of the things in so doing, one of the major things it's doing is helping you develop an accurate estimate of how, different business segments are consuming resources and delivering financial and operational outcomes. And actually, the key to doing that is really to understanding, individual activities within specific functions and a fair amount of detail. And that's what allows you to kind of create the insight and value. So, what's not always recognized is that there's really, and when you think about it, there's really no difference between supply chain planning, activity-based planning, cash flow forecasting, business process planning. It's all the same model, a really good model. It's all the same foundation. And you can extend that to a whole bunch of other things, ESG, strategic reason. Like I say, it's all the same thing. And what a really good model does is that it's helping you plan at the intersection of functions and activities. And that's the thing that really helping you quantify resource consumption across, like I say, functions and entities, and really understand how you how business users are consuming resources. So that's just activities, outcomes, and resources is kind of the central integrating structure. So from a financial perspective, what's a little different? So if you were kind of planning in a warehouse, one of the things that you might do if you were planning let's say, a large warehouse that did picking, you might use, so like an average rate of, $1 a pick or something like that to model it. But, if you're really managing at a granular level, what you're really trying to do is separate between, say, A, B, and C items, which are usually located in different parts of the warehouse and require um, different levels of effort, service levels. So somebody wanting their orders out within 24 hours is going to have a different cost structure than somebody willing to get it out within 3 days. And there's a whole bunch of other things that which could be attributes. You could have something that like fragile products have a different picking time than others. Heavy I mean, a whole bunch of other things. And this gets really important to understand when you've got different business units using shared resources, because when you start using averages, you end up getting the wrong number. So, one of the things I want to point out here is that what we're describing here is no different than what is currently being used in terms of the manufacturing floor. So, being able to use kind of bills and routing, or what we're basically doing is building the equivalent of a bill and routing for, kind of non-traditional, non-manufacturing activities. So, I have a bill of activities and resources. So I'm going to come back to this and use this, but I just wanted to show you that, we're saying that You can see that the minutes per pick is different, and this gets really important to understand when you start talking about looking at changes in volume and mix. So what we're showing here is that, I've got a this over here is kind of representing this kind of matrix and kind of detailed approach to planning. So what comes out of being able to plan at this level of detail is that I'm now able to plan, let's say, how many hours am I projected to use when I'm picking per picked item? What's my cost per pick? Then I can do that as at a cost per, say, cost per customer order. Um, and then I can look at it in terms of how are my perfect order fulfillment rates and days and receivable rates affecting that, especially when I'm kind of pointing it up. So if I want to have higher perfect order fulfillment, my cost structure is going to actually change. So being able to have that level of understanding. As well, being able to use that in order to drive value alignment. So, based on my an understanding of how different customers using different picks, now I'm looking at how processes and activities are affecting the cost and profitability of specific customers. So, back to what I mentioned before in terms of activity-based costing, you should be able to do this on a forward-looking basis and understanding, what are my forecasted service levels and versus my planned service levels. So if you've got a customer that's, tending to consume more resources than you expect, for example, if you expected them to expedite orders, 5% of the time, and now they're expediting 25% of the time, you're expecting that it's gonna decrease your profitability. And, you can do this because you're having a deeper understanding or you're planning at a much lower level of detail. So, by line item in your forecast, you're able to forecast how different products and customers and segments are actually consuming resources. So going back to what I said, that it's really in a lot of cases these variations in terms of customer profitability are driven by the mix of activities and not the actual activities themselves. So going back to what I said before, I mentioned this thing for the warehouse. So this is what the standards that we use. So if you looked at the actual detailed forecast, you could then kind of summarize it and say, okay, well, this is now my summarized view of the cost and my staffing levels required for the warehouse. And a warehouse guy should be able to look at this and say, I know where these numbers came from. They're my numbers on the left-hand side. So what should fall out of this is a budget or a financial forecast that he should be willing to live with, as well as a projected cost per order. So this was the thing that I was showing you in the graphics. Now, a couple things to remember, when we think about these models, like one of the things about how you kind of think about modeling. So in the same way that you've got a bill and a routing, that's an example of an object-based planning model where you can have, you've got, in a routing, you've got connected activities and flows, you know what the productivity rates are, you know what the unit costs are. It's the exact same structure. But one of the things that's not included in kind of financial tools is the ability to take these models and kind of compartmentalize them or decompose them in such a way that you can actually have different owners of these different models. So in the case of the warehouse guy can actually own these different components of the model, as well as one of the things that makes this a little bit difficult in kind of financial planning tools. I mean, one of the things about, and I'm not going to profess to be kind of like the technology expert, but one of the biggest problems of, like there's some tools, FP&A tools out there that are, kind of getting into the, supply chain planning space, and there's kind of one in particular that's making a big push. But one of the things these tools are kind of struggling with, is a lack of what's in these a lot of these supply chain planning tools, which is this thing called global unique identifiers. So what that means is, so if you've got a product number in kind of like supply chain planning tools, if you've got a product number 123, um, one of the things about a supply chain planning tool, you could change that to product number 456, but internally it has a number that's associated with that. And one of the big things about that is that it allows, a lot of chain flexibility, because if you're not using the same numbering system across all time periods and business units, you're going to have a lot of difficulty maintaining the integrity of the model. As well as, like, one of the things, these model like in FP&A, these models are not built for speed. So, for example, in a lot of these more integrated tools, you've got people who are designing table structures that are optimized for both speed of execution and speed of creating um, scenarios. So in some cases, you get tools like, especially like some supply chain planning tools have this problem where, you want to create a scenario, and they're creating a copy of your model, and it takes you 4 to 8 hours just to create the scenario, and because of the volumes. Whereas in something that's made for scenario planning, you create a scenario in less than a minute. And not only that, they're kind of designed to actually execute quick. And that's one of the big problems with kind of FP&A tools. And you can see there's a lot of things down here that are just really problematic with FP&A tools. They're just really not made to handle this kind of complexity. So, this is kind of one of the challenges that companies are having when they start adopting kind of FP&A or XP&A tools that weren't necessarily designed for supply chain. So, I mean, one of the things I'm saying here is, one of the things about having a really good foundation is that one of the things these things do as well, but having a structure, is that these structures are the things that allow you to use prescriptive analytics. And if you don't have these kind of, foundational and what I call these object-based structures, that's why you're not going to see very many FP&A tools utilizing prescriptive analytics. Because, I mean, if I, as a finance guy, one of the things I would be looking for is a tool that would allow me to, start with something simple, and then scale to an analytics tool that's going to allow me to utilize it in other parts of finance, say for tax and treasury. And that's just not happening, which is like, uh, I guess one of the problems why, a lot of organizations are still having difficulty doing kind of scenario playing and analytics. So you can see here's one here that, there's a lot of difficulty with scenario planning. It's not terribly efficient. Here's one that's done by the Modern Finance Forum, that 80% of analytics efforts miss the mark. And much of this has to do with the structure of the financial tools. And here's another recent one by Gartner, that says a lot of these advanced analytics investments are going to fall short. And one of the primary reasons for this is that FP&A tools simply weren't made for analytics, especially in manufacturing. I'm not going to make that statement for, like, banking or, financial institutions, but in manufacturing, these tools just simply weren't made to do what people are professing them to do. And one of the reasons for this, I think, is that, solution providers, I think, are kind of having tunnel vision, and they're continuing to develop these solutions in silos and really not doing anything that's really innovative. And which is one of the reasons why you don't see very many FP&A tools offering anything remotely close to helping out supply chain finance functions. And what you end up with is that you still have a lot of gaps that companies are dealing with. And I know that, Richard, you've kind of seen some of these things, especially as it relates to scenario planning and being able to, execute these scenarios and create them quickly, and developing executable plans. Those are some of the things you're still seeing
Oh
out
yeah.
there. And yeah.
Well, a lot of the if I go out and I do a request for an IBP system, an IBP tool, right? A lot of the vast majority of the vendors are going to come back with multiple tools, right? Again, they're going to have a demand tool, they're going to have a supply tool, they're going to have a finance or a daily operation tool. Um, these are standalone tools that they go out and they support them standalone. Um, if I try and put that into some kind of integrated system, well, if I've got a demand manager who logs into a demand application, creates a demand, passes it over, then has to go log into some different system in order to see, all right, how is supply going to meet that demand, or is supply going to meet that demand? Things like that, right? When they're handoffs. When
Yeah.
that happens, how do I do a what if it will if I do a what if on okay, I want to see what's gonna if I make some adjustments to how I'm gonna sell. If I want to go out and I want to do something with customer lead time, I want to I can get 10-15% more volume if I cut my customer order lead time in half. Well, I don't have a what I can't build a what if across multiple standalone systems, right?
Yeah.
I need that one model to
Yeah.
be able to see it.
Yeah, and even so, there's definitely a lot of older tools that are having these issues, and I know there's some newer ones, but even some of the newer ones still aren't delivering what we've called an executable plan, which is like the whole enchilada, um, especially when it comes to kind of doing direct cash flow and profit forecasting. So,
Right.
and even some of these newer tools, the one of the things I mentioned was, being made for scenario planning. Even some of these newer tools, and ones that are rated very highly have this problem. Like you go to create a scenario and you're waiting there for hours. And not only are you waiting there for hours, it's not really covering the entire business.
Right.
So
And
that's
by the time I get an answer from the scenario, well, wait a minute, the market has changed. All my inputs have changed,
right,
right? Especially if I've got the standard 4 to 5 week IBP process.
right.
Yeah.
So that's kind of like one of the key things. So in light of that, so uh, let's move on to the next section. So this next section, we're going to take what we've learned so far. I'm going to apply this to a case study, and this case study is one that I personally worked on. It's actually, two or three case studies kind of combined with one major one, uh, really kind of underneath it all. But it's really kind of illustrating some of the things that are some of the challenges with kind of FP&A processes and solution, and the fact that, one of the things I'm going to end up saying is that a lot of these solutions are doing more to erode value and undermine strategy, as well as undermining finance transformation. I'm going to get into some specifics as to why this is. But let's kind of dig into it. So the case study I want to highlight is that of a company that published school books. And we were brought in. Um, there had been like this was like an annual, like they had like an annual um, calendar for financial reporting, and there had been a significant deterioration in performance, a lot of high inventory stockouts, and this kind of came in about the May-June timeframe, and that followed like a really long annual planning process. And some of the processes and systems that they had, like they had kind of an FP&A tool that if you look, most technology analysts rate it as one of their leading vendors, and they were using a rolling forecast. They're using an S&OP process, but they're using sort of an older ERP system. And the product background, just so you can appreciate this, like many years ago, like, if you look, say, for history books, you might have kind of um, all maybe one hit offering one history book for an entire country, like in the United States. But what ended up happening is that, as time went on, each state, started introducing their own variations and had state specific chapters. And then you had related materials, teachers' aids and testings, and then digital materials came on. So the whole idea was that a book was not a book anymore. It just got way more complicated. And so when all was said and done, we ended up recovering control. But what ended up happening that the company lost about 50% of its profits for that year, and it was really a disastrous thing. And one of the things that we ended up telling the company was that, really it was your planning processes were terribly ineffective. And especially in parts of your supply chain function, it wasn't so much the process as that you were incredibly understaffed in this one part of the process, and that if you did not make significant changes, especially investing in kind of either an ERP or supply chain solution, you are going to have some major solutions or major problems. And of course, one of the things that was that initial statement wasn't really well received. They didn't really believe it. So, the question then was, well, how do we get there? And so one of the things I'm going to lead you through right now is just talk to you about some of the analysis we did. Now, this is sort of a simplified version of, what was happening. So if you break down, and again, I've kind of doctored up the numbers just to illustrate what the problem is. So if you look at the number of items, if you look at there's 5,000 book titles and there's the percentage mix. So A's are really kind of simple books, easy to do. D's are sort of more complicated one. They're harder to do. So one of the things was, and especially, they had, more demand variability. So one of the things, in order to achieve the inventory turnover that they required, they had to do a lot more reviews. So, you know, easier to manage books with more consistent demand. They were looking at them 5 times a year versus, every week for some others. And of course, the hours per review were, very different. So zero point 0.2 here, and 4 hours here with an average of this. So if you just kind of do the math, this number times this many reviews times hours per review, you get the number of hours and how many FTEs. Now, historically, this worked well. This kind of the 24 here, this was kind of like, what the CFO is basically using and had historically used to set budget. So we, actually derive like sort of for every $1 million of sales or 10 million of sales, this is how many people I need within the supply chain group. So what ended up happening this particular year was, so if this was how many titles that they end up having, the mix actually ended up changing. So if you just kind of run through the math, this is how many people that they actually really needed, and this is what they were staffing to. So one of the problems that what they were having is that they weren't doing the right reviews at the right time, and they just didn't have the staff available to do the work. And then, of course, one of the things as you kind of look at, where the company was going, and if you just kind of do the math, this is where they were headed in terms of the mix. So if you just do the math, that's the number that they got to. So when we walked through this with a CFO, his reaction was, "Oh my God, I had no idea this was happening." And, to which the supply chain person said, "Well, I've been telling you this for years. You've just chosen not to believe me." And so, which is one of the reasons why we went through this kind of long and laborious, process um, of budgeting. It was just a painful process just to kind of fight for resources. So, almost immediately, one of the things that ended up happening is that they basically launched an effort to do the, invest in ERP or supply chain solutions almost the next day. Now, obviously, one of the things that you can imagine, this was far more complicated what I'm showing here, but you kind of get the math. But what underlies this, so this isn't the first time I've run across this. So let me kind of walk through, like, what are the key learnings from this. First off, like if you're trying to be kind of a strategic finance person, one of the things that I think a CFO should be really on their radar is the ability to develop like an executable plan, meaning, you know, given the demand we've got coming at us, have we got the right number of people? So like just, a basic question that most companies really can't answer is how many people do we need? They might be able to answer that within the manufacturing department, maybe in some supply chain functions, but they can't really do it in other functions. So in this case, the inability to answer this question wiped out half of their profits. So one of the things that's kind of falling between the cracks is this ability to develop executable plans, and kind of it's really falling on no one to do it because it's outside the realm of supply chain. The second thing that kind of you look at here is that whatever you know uh, methods and processes that they were using to develop new products and develop strategy certainly wasn't answering delivering right answers to them because they never would have gotten into a lot of things and not taken any action. So the models they were using were actually wrong, and that all of this stuff is kind of falling between the cracks of both, FP&A and IBP. So it's like the rolling forecast model certainly didn't pick it up because it was far too simplistic. So what ended up happening, as a matter of fact, this is actually quite interesting. So the person that I was doing this work for, she loved what I did. In fact, she actually took the spreadsheet and started managing her department with it. Not that it was all that complicated to begin with, but she basically took over using this model and basically had somebody maintaining it on a regular basis. So it was an activity and resource-based model that reflect all these difference in service levels and responsive to volume and mix. So what ended up happening was that because of the conversation that they just had with the CFO and because of his confidence in the model, the whole tone uh, of the conversation with the CFO fundamentally altered. So it was, you tell me what kind of volume and service level you got, and I'll tell you what the resources are. So the whole tone of the planning process was all about managing expectations. But the thing that was actually really interesting was how it affected cycle time. She went from spending like months, as part of the annual budgeting process to spending less than a week on budgeting and less than a day on rolling forecasts. It was like massive reductions, like 95% massive reductions. And this is kind of one of the things that's problematic with a traditional budgeting process, because one of the things that, finance people don't necessarily think about is that people are always kind of thinking in the back of their minds, how am I going to get the resources I need to to meet my objectives? Because one of the things, if I'll get into this discussion about these kind of, I'll call these unwritten rules. If you see them down here, like always under promise and over deliver, if you're not using a process that I can actually quantify resource consumption or say how many people do I need and have those kind of explicit conversations, you will never get in complex companies, you'll never get to like a real dynamic budgeting process. And this is kind of like one of the problems with kind of, I'll call them like really kind of traditional finance functions. They don't really recognize how the methods that they are using um, kind of to simplify their financial planning are actually causing terribly wrong behavior and really long uh, budgeting processes. So one of the key things here, so first of all, I think an effective rolling forecast process looks way more like traditional S&OP than what, has been described in, I think rolling forecasts first came out from a book called Beyond Budgeting. I think that's far too simplistic for like major manufacturers or global manufacturers, that you need to be more cognizant of, how you're actually going to take work out of the process and make it far more transparent. and drive the right behaviors, focus it on trade-offs and expectations, leverage frontline knowledge, and also expose and understand how service levels are actually driving costs. Because one of the things that people don't really realize is that that's one of the biggest levers that organizations have is the ability to change service levels in order to drive cost reductions. And the ability to do all that is one of the things that actually can help you kind of reduce the annual budgeting process, especially as it relates to focusing on productivity as opposed to fixed annual budgets. So a couple things related to that that I wanted to make you aware of. So, this warehouse example that I mentioned in the last section is exactly the same as this one I just mentioned to you. So, one of the things is that while this may look like it takes more work, I can assure you that, I mean, as somebody who's done this manually in many different departments, you can take out months, if, or many, many man hours in a budgeting process simply by having something that looks more like a S&OP process that has, some good standards behind it and kind of deliver the types of, improvements that we showed in this case. The second thing is that, a couple sections ago, I showed you this page. Here's the thing, if you cannot show this and then be able to manage this, the chances of you eliminating functional silos and the dysfunctional budgeting are kind of slim to none. Because what you really want people focused on are, cost thing like an order to cash process. You want them focused on cost per order, not what my fixed budget was. You want them to, deliver what they were supposed to deliver, and underneath you may have like overall it might be $10 an order and $5 an order for one segment, $8 an order for another, and $20 an order for another segment. That's what you want them focused on, and you want that kind of focus across functions and legal entities. But you're never going to get people away from kind of fixed budgets until you can reconcile it to the financials, because there's going to be this transition period. So the whole idea of this isn't just for you know, uh, just to kind of tie the numbers out. You're just not going to get the same confidence in the ability to manage towards relative financial targets unless people know that it reconciles back to what you're actually spending. And the last thing that I wanted to mention here is that one of the things that we talked about in this whole process was the idea of the department manager managing the expectations of the CFO. One of the things that you want to take that I'll highlight in a couple sections from now is that if you can't manage expectations internally, the likelihood of you managing expectations externally with your customers is going to be very slim. And as you can see here, that there's this, especially this one's here, companies who think that they're, customer focused, most, most companies and most customers don't agree, primarily because they're not managing expectations. And I'll come back to that in a sec. So one of the main things I want to leave you with in this section here is that these legacy solutions are doing little to kind of help you kind of drive cross-functional performance, drive finance and other forms of transformation, because they're kind of reinforcing silos and they're not really helping you manage the entire business. So that's kind of like the key takeaway from this section. So we're going to take what we just learned in these previous sections and apply it to like an integrated process. So one of the things I just want to say here is that if you look like kind of a traditional S&OP process, a five-step process, and there's kind of like one for rolling forecast. But what you see at the top is sort of one view of what an integrated process might look like. And really, one of the things that we're trying to do is go from like a monthly process that may take over 4 to 6 weeks, which is more sequential, to one that is more concurrent, and which kind of collapses it. So one of the things that's really driving a lot of this is that these sub processes and having one model, and this is kind of like one of the major innovations, is that being able to drive a lot of these processes very quickly. So what's happening down here is that you're kind of quantifying your basic manufacturing and supply chain volumes, translating those volumes into kind of other supply chain and activity volumes, then translating that into activity costs and then into kind of direct cash flows, P&L balance sheet, using that then to quantify product, customer, and segment profitability, and then calculating variances. And that those things are kind of the things that are really driving the innovations in terms of speed. And one area where it's also driving innovations is in the area of new product development because you can use the same models to really kind of quantify how new products and customers are affecting different parts of the process. But one of the things that's kind of going on here that makes things really quick. So you saw in that book publisher example that you're updating your models, managing performance, and keeping everything up to date, managing cross-functionally, and again distributing ownership of the model parameters. So you can, one of the things you first do is just everybody updates their own models as opposed to concentrating that in finance. The next thing that we're doing is, forecasting revenue and demand. But, one of the things that we're doing is that we're forecasting at a fairly low level of detail in a way to forecast resource consumption. And this is, being able to do that is one of the things that's kind of essential if you want to have a real market focus approach, especially like for outside in IBP, you're really kind of translating how different market segments drive resource consumption across the business. Then what you're doing quickly is kind of quantifying resource consumption from a top-down perspective using those models. But then one of the things as like we showed in the warehouse example, once you do the calculations, having the department managers look at them and say, yeah, those things make sense to me. I understand where they came from. And then utilizing the ability to look at profitability targets and then either make any sort of service level adjustments or internal adjustments to avoid having profitability problems, and then using scenario planning to resolve problems, and then finalizing deploying plan. So basically one of the things when you're finalizing you're deploying both the operational plan and the um, financial plan. And one of the things that where you find that where the big differences are being made, especially in finance, is that you know a lot of the activities within supply chain finance end up going away because you're eliminating a lot of redundant processes and non-value add activities. So just in terms of kind of like you know the ability to kind of collapse processes like that. So Richard, I'm assuming that one of the things you've told me is that being able to kind of go away from sequential to concurrent process is a big thing for you, right?
Yeah, yeah. Somehow being able to collapse that 4 to 5 week process down into 2 to 3 day kind of, yeah, ideally.
Yeah.
Uh, yep.
Yeah, well, this whole thing kind of get done in like, 2 to 3 weeks, maybe 2.5. So there's
Yeah.
some big changes to be had, big
Yeah, I think
improvements.
the power, yeah, I think the power here in this is, you're building out a plan, and then every day we're checking how we performing against the plan. But because that plan is that end-to-end model you described, I can take any kind of upset to the plan, any kind of potential, and overnight I can say, okay, well, what impact does this have on the plan? I can get those three people, the demand, the supply, and the financial manager looking and saying, okay, well, what actions do we need to take? Because it's all integrated. I don't have any of these unintended. I've modeled all the consequences. I don't have any unintended consequences that I've got to wait on.
Right. So with that, let me just quickly walk through, how this what we're saying is different than what's out there in terms of maturity models. So the first thing I just want to mention that, there's been a lot of technology innovations over the past, a decade or so. And if you look at these legacy solutions, I don't think that they've really kind of taken advantage of it. I think the market is really suffering from an innovation gap, which is really leading to a number of unmet expectations. I think that, if we look where we were 10 years ago, I think a lot of people, and especially people like yourself, Richard, have told me that you would have expected a lot of these companies to be a lot further ahead than where they are now. And especially when it comes to, kind of some of these, like what I call more operationally savvy CFOs. I mean, one of the things you hear a lot of these legacy solution providers talking about is how they do scenario planning and do all these great and wonderful things. But one of the things that I think that, really savvy CFOs are coming to realize is that this just isn't true, because the reality is that you can't possibly have a really good financial planning process without having a supply chain planning model underneath it. Not going to happen. Like, especially if you want to try and make decisions with cash and profitability, FP&A solutions just aren't there. So the reality is that a lot of these solution providers that are telling you that do these things, these are just materially inaccurate statements. You can see, I kind of, uh, you know, uh, 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 I guess blacked out, I guess, or white out some of the things, but you can kind of get the drift of what more operationally savvy finance guys are saying. So what they're seeing is that the same things I think that you and I are seeing is that there's just these capability gaps that we've talked about already that just really aren't being fixed. So in the supply chain world, you may have the best supply chain planning solution in the world that optimizes gross profit and supply costs, but it's not really helping you optimize enterprise cost profitability. So what you're really looking for is more mature solutions that can actually do the whole thing. But what's one of the things that's really happening here, like especially when you think about forward-thinking companies, is that there's two markets. Like I'll call them legacy planning and performance management, and kind of fully integrated one. So, this is a pretty mature market, and this is a newer emerging market. And a lot of companies are kind of like at the mid stage in here. But what we're talking about is a new emerging market. And the I called it enterprise performance management, but comparing kind of traditional FP&A and IBP solutions is like comparing like an old mobile phone to an iPhone. There's just really no comparison to what we're talking about. A lot of these solutions are just not even in the same class. So one of the issues is that um, these older solutions really have some major gaps in terms of planning and performance management. Um, and that what we're talking about here is, just to put a label on it, these enterprise planning and performance management systems are something that kind of integrates and sits on top of the two. And that the absence of this is really kind of leading a lot of these capability gaps or companies seeing and the ones we just talked about. And it's really representative of the trade-offs that we mentioned. And so basically, we're still not fixing functional silos, still no ownership of gross profit. So the reality is that a lot of these tools just aren't doing what they say they're doing, and that's why we have this gap that we talked about, this um, big performance gap. So it takes a longer time to get there, and you're not getting as much value. So if you look at these things, so this is kind of a copy of what I just showed you. If you look at a lot of these different research studies, there's no evidence to say that a lot of these tools are fixing these things. In fact, I don't think FP&A and IBP tools are they're doing very little to fix these problems. Same thing with strategy. Remember, I told you I come back to kind of managing customer expectations. They're doing little to address these things because they're not fixing these gaps. And likewise with transformation. Like transformation, I'd say that one of the biggest problems is that these tools are doing more to undermine transformation than they are to support them. And so it's really a myth. So if I had, especially finance, I go so far to say is I think a lot of these FP&A tools are doing more to undermine transformation than they are to support them. And that, the reality is that they're really not optimizing cost, profits, and value, and here's kind of like all the a summary of all the things that we showed, and they're really kind of um, causing these complexity costs, which we talked about. And I'm gonna come back to this in a later section. I'm not going to repeat all these things. So one of the things I just mentioned was that they're not managing profitability. And if you look at all these red things, these are all kind of recent research studies that say, all these claims of these companies, software companies managing profitability I don't think are true at all. Most of them are still relying on activity-based costing. You're just seeing none of them that really kind of driving the types of insights that we're talking about. So it's a bit of a myth that they're doing that. And I did a research study a number of years ago, and these were the results. Here's kind of the top results. The reality is that the things we're talking about today have been around for over 20 years, and I just don't see a lot of these solution providers of addressing them. So, I did another one for CFO magazine, same sort of results, and there were some other things that we came up with. But the main point here is that, we keep talking about the same things, but they're never being fixed. All right. So what's really missing is the ability to do what I call or we introduced dynamic cost optimization. And the reality is that I don't think anybody would really say that their solutions are really doing that, and most of them are not. And if you look at a lot of what these kind of FP&A solutions are talking about, as well as some of the supply chain solutions, they're using just a bunch of buzzwords to cover up the fact that they really don't do what they say they do. And that, here's one thing I saw on one site. And there's one of the problems I think people are talking about extended planning analysis as something that's going to fix all this. I just don't see it happening. As somebody who's used these things, they're just not delivering the same sorts of results. So this is kind of a summary of kind of the maturity models and where we're at, and we'll use that as a foundation for our next section. So I just want to build on what we talked about and talk about some synergies. I'm not going to spend a lot of time on this section, but talk about some things which are kind of related. Uh, the first one is that outside in planning, we showed this before, but I think outside in planning, one of the things we're really trying to do is drive a market responsive process. I think all these capability gaps that we've talked about are all things that are kind of critical to making outside in planning work. And that the ability to develop executable plans is going to be central to being able to do that, and having activities and outcomes and resources at the central piece to also support dynamic optimization is just kind of a key component to doing that. But the ability to to have activities and outcomes at the center, is really central to just about every part of the management process. But it's not just ones we've been talking about, it's other ones as well, especially something like ESG, but there's other ones, risk management, project management, internal control management. A lot of especially this one here is, you can see kind of supply chain and FP&A solutions talking about integrating, but I think they're kind of missing the point. Because one of the things when you talk about ESG and integrated reporting and thinking, one of the things that they've correctly pointed out is that the central component of these methods is really outcomes, activities, and processes. So that's kind of one thing that they've kind of missed. So when the key takeaway from this section, I think that's that, when you look at kind of integrated planning, there's an opportunity to look more holistically and look at other things. So one of the things now I just want to talk about is kind of leveraging the insights and some things you ought to think about as you kind of go forward. So the first insight is to understand kind of like the key capabilities. And the one capability that kind of stands apart from other ones is the ability to manage trade-offs, and that's kind of the one that Gartner pointed out. But the others that we pointed out here were, in planning and performance management and process changes, so being able to do scenario planning, customer profitability, developing executable plans, cross-functional alignment, and integrating rolling forecast. And these are sorts of things that, if you're going to look at, kind of solutions or solution providers, they ought to be able to do this stuff. So the first thing kind of take away is, from this is just understanding what the capabilities are, then understanding what the value sources are. We talked about the value being uh, a big part of that value coming from managing complexity costs, and the long-term ROI can be very significant. And we identified some of the strategic value sources, like reducing the amount of overserved customers and managing it on an ongoing basis, and some tactical value opportunities in terms of reducing the cost of planning and managing your business and reducing technology costs. Stakeholder challenges. So I told you I'd come back to this slide, the business challenges. I mean, one of the things that, when you're trying to, establish a process like this and then the process of getting people to think about it is you got to answer the question, what's in it for me and what problem am I solving for you? So I've shown some of the ones over here. So business growth and cost reduction are in here, transformation, management. There's some management challenges, especially in supply chain. So kind of connecting the dots and helping people understand how it solves problems that are important to them. Um, Also need to understand kind of like a technology enable. So the one thing I want to get across that what we're talking about here doesn't necessarily mean throwing away what you already have. It could mean kind of leveraging what you've got. But the main point here is that there are solution providers that have kind of um, are supporting this kind of enterprise-wide, these broader enterprise-wide capabilities. Um, Now, some of the newer ones may, while they do have significant innovation, some may be perceived as being higher perceived risk, despite the fact that they have value potential just because they're new. Now, having said that, there are some older solutions, especially in supply chain, that are doing really interesting things, although they're not really advertising it as such. But there are alternatives. The next thing is being able to understand, look at kind of self-funding value, especially when it comes to, with this complexity costs. I think there's an opportunity for many companies to self-fund within kind of 3 to 6 months, if not, self-fund, which is 1x, but there are opportunities to get more, but much of that is revolved around building standalone models to address specific issues. Like, for example, like tariffs, for example. I think, Richard, you told me that you have one company that has that as an issue they're dealing with, right?
Yeah, talking just this week, they're trying to make decisions on global sourcing, right?
Yeah,
And one of the biggest impact of that right now is these tariff discussions, right? So it's taken them week after multiple weeks to try and come up with a what if around um, where they're going to source their product, where they're going to manufacture. And these tariffs are changing daily, right? So
right.
it's very difficult for them. Yeah.
Yeah, well, the thing here is that, the better solutions, you can use them on a standalone basis as a kind of an insight tool. Like you can use it to identify unprofitable products and customers as well. But the nice thing is that you can use that without having a big monolithic project that requires a lot of people to create immediate value and then utilize the model afterwards to support a process. But the idea is that
Hmm.
if you're not self-funding this thing within the first few months, leveraging some of these tools and processes, you're kind of doing something wrong. So that's kind of like one of the big differentiators in terms of how you think about these tools.
Yeah.
So based on that, one of the things, once you've seen these insights that you can get, you start building the right foundation. I think that one of the things that you've always told me, Richard, is educating the executive team and getting the right sponsor, which is a big part of kind of leveraging these sorts of innovations, right?
Yeah, exactly. Exactly. It's you always struggle with trying to get the CFO involvement, right? Getting finance involvement, right?
Yeah,
Because yeah, it's always an after effect, right? You have operations, you have commercial back and forth on revenue, direct spend, and volume. They're always talking volume, and then
yeah,
the financial impact. Well, imagine the if you could get the finance people a lot more involved with on the front end On the demand side, they're talking revenue. On the supply side, they're talking spend. And that's the way you integrate your financial group into your planning processes.
Yeah, so I think a lot of this is just getting everybody on the same page. And one of the things that can help you that that's actually one of the reasons why we formed PACE, the Manufacturing Special Interest Group to begin with, is because, there's really if you look out there, there's a lot of really outdated perspectives, technology analysts and solution providers, and that what we're really trying to do is help companies work with other kind of forward-thinking manufacturers who are kind of seeing the same amount of noise, if you will, in the marketplace, and also to help them cope. I guess, one of the challenges that, companies have to deal with, CIOs that may not understand this as well. And, if they're relying on technology analysts to inform what solutions they ought to be providing, some, external evidence that what's being shown as, kind of leading practice just really isn't. So those are kind of some of the things to think about. So some of the things just to kind of wrap up and kind of summarize, I use this as a uh, just to kind of depict kind of what's going on. I think that, kind of people who are kind of looking at the market or just jumping in the market, the implicit assumption is that, if you just kind of follow, what the technology analysts would say and what's being talked about out there, that you're going to get the right direction. I don't think that's the case at all. I think that those who've been there before are recognizing that, the market has moved significantly and what's out there, as purported to be leading practices is probably I'd say 5 to 10 years behind the times. I don't know if you would agree to that, Richard, but that's kind of
Yeah.
like my take on it. And going back to this one side that we initially dealt with is that, you can get there a lot faster um, and create way more value by taking a step back and looking at what's currently out there and looking at taking a different approach. And the one thing you got to remember is that um, if you look at kind of like the circle size of legacy performance management, the market size for kind of like these, I'll call it these legacy solutions, is huge. And the market size for what we're talking about is pretty small. In fact, that dot's probably
Mhm.
way too big. There's a lot of people who, well, you can kind of read into this, but a lot of people have a vested interest in maintaining this kind of status quo. And they're not always as objective as you'd like them to be, especially company. If you look at anybody who's implementing traditional FP&A solutions, you should not be looking to for advice about what's leading practice in FP&A because they're probably not the most independent people in the world. Okay, that's obviously a bit of an exaggeration, but you need to be careful anyway because
Yep.
they may not be looking at, and you can probably make the same same statement about um, the IBP solutions. But kind of like the main takeaway here from all of this stuff is that, um, I think that there's things happening out there that just are really kind of going unnoticed. And, one of the things that we're trying to promote here at Pace is to get people to think a little bit differently and take a more holistic approach because there's things that they can do to really kind of take advantage of, the opportunity. So with all that, I want to say thank you. And if you got any questions, you can use the contact information there. And Richard, thanks for taking the time to
My
spend on
pleasure.
this. I really appreciate it.
My pleasure. I really like what you've shown so far. If I can summarize from my view, what I've seen, right, is I do my Dr. Phil moment with the old technology. And how's that been working out for you, right? And I think all of us can kind of say, well, you look at the LinkedIn, you looked at all these others, and people aren't achieving the impact that IBP, the promise of IBP, right? This old technology isn't getting us there, and what you've kind of described uh, ahead of us. If I say what's the most important thing in my IBP process to focus on, well, to me, it's cash flow. Cash flow is what I use to fund my business, what I use to invest in growth. It's what I use to delight my shareholders. And if with this integrated technology you described, I can sit and I can do what ifs around what am I going to sell, what am I going to make, and I can immediately see, well, here's a very good prediction of what that impact is going to have on your cash flow over the next 18 to 24 months. Well, that's what I'm looking for in my IBP process. I think that's what the big breakthrough that's coming next is, if that makes sense to you.
Yeah, I would totally agree. So with that, I want to thank people for watching the video. And again, any questions, feel free to reach out.
Appreciate it.